Good afternoon. My name is Fundi Chazibana. I'm the Deputy Governor at the South African Reserve Bank. And a warm welcome from those of you across the world who are attending this virtual BIS South African Reserve Bank Centenary Conference. This year, the South African Reserve Bank is celebrating 100 years of existence, and we have this collaboration with the Bank for International Settlements to explore new and old subjects in central banking in the context of COVID-19. The session that I'm chairing today is titled Not a Financial Crisis, Revisiting Old and New Risks to Financial Stability and Recovery. And we picked this topic because although we are not in a financial crisis, there are a number of financial vulnerabilities in the horizon. And the objective of this session is to assess whether some of the old risks to financial stability that we are familiar with still exist and whether there are new risks that we have to deal with. Allow me, before I begin the session, to go through a number of housekeeping rules. All microphones should stay muted unless one is presenting or a question is being asked by those who are on the panel platform. The floor will be open for questions and discussion once the lead discussants have completed their session. And the panelists who are on the platform can utilize the raise hand function. For those who are on the attendees list, we'll request that you don't use the raise hand platform, but rather you should utilize the chat function to phrase your questions, please. This session is going to be recorded and published on the South African Reserve Bank and Bank for International Settlements social media platforms immediately after the session is completed today. At this point, allow me to introduce my esteemed panel members for the session. Our lead speaker is Hyun Shin, who is the economic advisor and head of research at the Bank for International Settlements. And as the Bank for International Settlements advisor, Mr. Shin co-leads the monetary and economic department as part of the BIS's senior management and as a member of the executive committee. In his previous incarnations, he's also a professor, but he does prefer to go by Mr. In this session. We're also joined by Laura Alfaro, who is with the Harvard Business School, and she is also a member of the National Bureau of Economic Research and the Center for Economic Policy Research, International Economics, and Finance and International Trade and Investment Programs. She's also a fellow at Brookings. Our second discussant is Lema Sandberg, who's a professor at the University of Maryland. And Professor Sandberg is the professor of finance in that space. And while he was on extended leave in the past, he's been the executive director and the chief executive officer of the African Economic Research Consortium. He's also on the advisory panel at Brookings. He's also been professor at a number of other universities as well. Thank you very much to my panelists. Our time is very tight today, and I prefer to give a lot more space to the panelists and for questions and answers. So without much further ado, allow me to allow Hyun to take over. Hyun, over to you, please, to take us through your presentation.
Well, thank you, Fundi. It's really a great pleasure to join you and the other panelists. And let me thank you also for inviting the BIS to be the co-organizer of this very important and a landmark event. Let me share my slides, and then we can proceed. I hope you can see that.
Perfect, they're visible now.
Excellent. Well, this session is going to be a very good follow-up to the session that Kuben chaired yesterday, which was on fiscal space and and the financial stability and the broader macro stability implications of fiscal space or the lack thereof. And what I'd like to do today is to follow up on that discussion and bring in more of a financial stability angle and a view through the lens of capital flows. And what I've done is to title this presentation "Overcoming Original Sin to Secure Policy Space." And here I have very much in mind securing fiscal policy space. Now, as we mentioned yesterday, fiscal policy really has led the way in the policy response to the pandemic. And it's given rise to large budget deficits and increased debt levels, both in advanced and emerging economies. And here's a snapshot. So as of the end of last year, we saw that the red line here, which is the budget deficit as a proportion of GDP, really grow very large for both advanced and emerging economies. And here in blue is a chart for emerging economies. And we're expecting to see these budget deficits to be continuing at fairly sizable levels as we deploy the policies designed to meet the challenges of COVID. Now, fortunately, most emerging market economies have one advantage, which is that at least for the sovereign borrowers, they have well and truly overcome original sin. And by original sin, I'm referring to the proposition made very popular by Eichengreen, Hausman, and Panizza, which is the notion that if emerging markets want to borrow from foreigners, they have to do so in foreign currency. And this was a notion that really gained prominence after the 1990s emerging market crises, when the combination of currency mismatch and maturity mismatch, mainly through the banking sector, really was identified as the source of the vulnerabilities. Now, since then, there's been a very concerted attempt by all the countries that actually underwent crises in the 1990s, and by now we have a situation where, at least for the governments, for corporates that's another matter, but at least for governments, they are now able to borrow to a large part in their domestic currencies. And this is a snapshot as of the end of 2019, where the pink bars represent the proportion of government debt or central government debt securities that is denominated in domestic currency. And it's really only the blue that is the proportion that is denominated in foreign currency. And what's interesting, of course, is the pink hashed area, which is the proportion of domestic currency government bonds that are held by external investors. So that gives you a sense of the degree to which emerging markets, at least emerging market governments, have overcome original sin. And this, of course, is a very important element in overcoming the restrictions placed on emerging market governments to really deploy fiscal policy in the way that would be appropriate under the underlying fundamentals. Because if you could deploy fiscal policy financed through domestic currency debt, that removes one very important source of vulnerability, which is the currency mismatch. Now, unfortunately, though, being able to borrow in domestic currency, so having overcome original sin, what we are finding is that overcoming original sin by itself is not by itself a panacea in securing policy space. And one way to see this is just to track the portfolio flows, portfolio debt flows, in the couple of years, over the pandemic period. And here we can include both corporate and sovereign bonds, so that we have a large amount of the foreign currency denominated bonds as well. And here I've plotted the cumulative flows from the beginning of 2020 up to the most recent period. And what we see here, as you can see from this chart, as the pandemic gained speed, we see these outflows in the early part of 2020, both in foreign currency and in domestic currency bonds. But around the third quarter, we see that the foreign currency bond flows basically recoup their losses. But that's not the case for the domestic currency bonds. And in fact, it's only very recently that we've seen the cumulative flows come back up to the pre-pandemic levels. And even so, the additional flows have been rather paltry. And if you were to ask the investors, what they would say is, look, these flows reflect in large part a sense of greater risk in the eyes of the investor community, where they see slower growth, greater vulnerability, and in some countries, these economic problems have also been compounded by a series of social and political and some social and political unrest as well. And we see that in the yields. The red line here shows the yields on the dollar-denominated debt, whereas the blue line gives the yield on the local currency-denominated debt. And you see that whereas the red line has really now come back down following global dollar yields, the same is not true of the blue line. And indeed, the yield curve has been fairly steep during this period. And that sense of disappointment from the investor community is also reflected in this chart, which shows the share of domestic currency sovereign bonds in the hands of foreign investors. And what I'm doing in this chart is to give a comparison of where things stand now compared to the high watermark over the 5 years between 2015 and 2020. And the horizontal black line gives you that high watermark, which is, how far was it the case that domestic currency sovereign bonds were in the hands of foreign investors, and what is the proportion today? And you see that in almost all cases, that proportion has fallen. And that proportion has fallen by quite a big margin in some countries. And here, South Africa is the second column here. We went from something above 40% to something more like 30% currently. Now, I think one thing that does come through is that although we have managed to overcome original sin, this hasn't been a panacea. I mean, it has removed some sources of vulnerability, but it hasn't completely removed the constraints on policy space. And one way of looking at this is to see how external conditions have interacted with the fiscal space in connection with domestic currency bonds. And one way that we can put this, to borrow a term that Augustin Carstens and I, is to say that original sin has given way to original sin redux. And the idea here is that even as the emerging market sovereign borrowers have graduated from the practice of borrowing in foreign currency, that currency mismatch has migrated, if you like, from the borrower's balance sheet to the investor's balance sheet, to the extent that the investor comes into the market on an unhedged basis. And to the extent that the investors are coming in on an unhedged basis, they are exposed both to the currency risk as well as to the underlying credit risk. And that double source of risk may give rise to behavior that still injects a great deal of procyclicality in the financial market. Let me spend 1 minute just explaining what this chart shows. So these charts show on the horizontal axis the weekly return to the domestic currency sovereign bond index as measured by the GBI-EM index. This is the JP Morgan index here. On the left-hand panel, I show the case of Brazil. On the right-hand panel, I show the case of Mexico. So the horizontal axis measures the weekly return in domestic currency terms of Brazilian government bonds. And the GBI-EM index, that's a kind of that's an investable segment. It's beyond the 2.5 years maturity, typically between 5 and 7 years maturity. So the duration is around 5 years. The vertical axis is showing the return, but measured in dollar terms. So what the scatter chart shows is as the domestic currency bonds appreciate or depreciate in domestic currency terms, what is the return as seen by an investor who evaluates returns in dollar terms? And what you see is that the relationship has a slope which is much bigger than 1. So if you look at this chart, the slope is 2.28, which is to say, for every percentage point appreciation, there's a 2.28 percentage point appreciation in dollar terms, and a minus 1% negative return. So minus 1% return translates into a minus 2.28% return in dollar terms. And of course, what is going on here is that the exchange rate is moving in such a way that amplifies the return, both on the upside and on the downside, as the domestic currency returns are positive or negative. And it reflects to some extent, you would think, so this is clearly an endogenous relationship, and it reflects to a large extent the kinds of the investment behavior of external investors that give rise endogenously to this kind of relationship. So the capital flows and the changes in the yields are correlated in a very strong way, as you see, with the exchange rate itself. In the case of Mexico, the slope is 2.04. So to the extent that you're multiplying the return by a constant, you can think of this as a kind of a duration multiplier. So if you have a bond which is of 5 years duration, you're multiplying the return by a factor of 2. So from a dollar investor's point of view, you're looking at a bond which is effectively a 10-year duration bond. And here's South Africa, and the slope is just below 2, but you see that the dots line up very closely, and we have Turkey on the right-hand panel. Now, when we plot the duration multipliers across the board, so when you plot the duration multipliers across the board, what you see is that the duration multipliers they cluster at around 2, but there are other countries that have a duration multiplier much lower than that. And let me draw your attention to the cases on the right-hand side of this chart. If you get to the UK, Sweden, and Chile, you have cases where the duration multiplier is actually less than 1. That's to say, the change in the exchange rate vis-a-vis the dollar is such that it tends to mitigate that the swings in the actual yield itself. And let's come back to these cases. I think it's very interesting to consider why it is that, for example, in the case of Chile, we have a number which is less than 1. But I think a really important policy question for us and this is perhaps where we can spend most of our time today, is to ask how can we mitigate original sin redux? Now, on the part of the borrower, we already covered this to some extent yesterday, in yesterday's session that Kuben chaired. And yesterday we heard Stan Duplessis talk about the importance of a funded pension fund sector. For a funded pension fund sector that's able to absorb the supply of domestic currency bonds, that is going to give you a very useful cushion to be able to be the counterpart to any fluctuations, to any procyclicality. And there will be an important role for hedging markets and the associated infrastructure as well. What's really intriguing, I think, though, is what can be done on the part of the investors. Now, to some extent, if we look at this chart, to some extent, it is a matter of converting the practice of the investors from coming into the market on an unhedged basis to one that's much more based on a hedged, investing on a hedged basis. I think that's certainly the case when you have the capital flows between advanced economies. But there's also another element here, which is that when we think about the benchmark itself, we're thinking very much about the dollar as being the numeraire. Now, if we do the calculation multipliers based on the euro, what we get are these blue diamonds, which are in some cases considerably below that of the dollar duration multipliers. And one way to interpret this is the euro plays less of a role as a barometer of the risk on, risk off, the barometer of risk appetite function. And to the extent that euro area based investors can enter the market, but very much have the euro exchange rate in mind, the bilateral exchange rate vis-a-vis the emerging market with the euro, they would be faced with a lower duration multiplier. And to that extent, you may conjecture that this could mitigate some of the procyclicality. This is especially interesting in the case of the yen. If we look at the yen and look at the duration multiplier for the yen, you see that there are some countries, here's Malaysia, Thailand, and Singapore, and Korea, where the duration multiplier is actually much lower. So in the case of a Japanese investor who's entering an emerging market, and they're entering based on a benchmark that is very much based on the yen, we may see some scope for a mutually beneficial outcome in that the borrower faces less procyclicality and the lender would face less risk. And I think that would be an entirely a desirable outcome. If such an outcome can be engineered, here's a final example of sterling. And I think here, when we think about what can be done on the part of the investor, typically the discussion quickly moves towards capital controls, ways to put sand in the wheels. I think some of that may eventually be needed. I think that's a discussion well worth having. But there may be other lower hanging fruit that has to do with mitigating the risk on, risk off attribute, if you like, of some exchange rate variables. So Fundi, let me finish there and let me stop sharing. And I will hand the floor back to you. Fundi, we can't hear you.
Should I share my slides?
Laura, I think we're having a mic problem with Fundi. Why don't you begin?
Can you see my slides?
Yes.
Okay. Thank you very much for the invitation. This has been a very informative, interesting a conference. Hopefully next time we will all meet in South Africa. Let me start. Let me see what's going on here. Okay, let me start with a definition that comes from a paper by Aiken Green Hausman and my good friend and co-author Hugo, where they describe what is the original sin. And they say is this inability of a country to borrow abroad in its own currency. What is interesting is that they say that this matters because this inability makes countries more volatile and crisis prone. And they continue to challenge us to find what are those channels and mechanisms that explain this relation. Note that in a footnote, they also explain that this inability to borrow in own currency is different from the inability to be able to borrow long term, and they actually think one is easier to overcome than the other one. When they wrote this series of papers, they were looking at data around 90s, early 2000s, and what is interesting, as Hume has shown, that some of this original sin has been overcome. And again, what is interesting is that some of these happened just around where they were writing these papers, 2002, 2004, with countries like Chile, for example, dramatically overcoming their sin. Other countries like South Africa have been famous for not being particularly burdened by the sin, but in general, you do see this overcoming of the sin, and we saw some more recent data on that. And so the question is, do emerging markets gain if the foreigners bear some of the exchange rate risk? And here, of course, it depends on the type of shock and the correlation of shocks. So let me put a very simple example: 2 periods, log utility, there's no endowment, sovereigns are just eating in the second period and deciding how much debt to take to the second period. There's one unit of non-tradable. The price, the exchange rate is the price of tradable to non-tradables. And I have two states of nature: a good state of nature, where I have more tradable, and a bad state of nature where I have less, probabilities 1/2. Let me assume I have debt dominated in local currency that pays R, risk neutral investors. There is no default. Again, the simplest exercise you can think of. And in this case, if you look at what I could consume in good times versus in bad times, one can think that there might be changes in the valuation of debt that can overcome those bad shocks. And indeed, if the exchange rate appreciates in good times, then this valuation affects, if you want, it the bad shock. And you can actually start accumulating reserves and debt in such a mixture that can give you some form of insurance, hedging, that will reduce this volatility. It just so happens that when you look at many emerging markets, and here I plot Brazil and South Africa, this is a simple rough correlation, but if you look at the GDP and the exchange rates, they tend to have negative correlation. In Brazil, I have done it with more detailed data, real exchange rate, HP filter, and it can be correlations as negative as high as 0.8, 0.65, depends on the period, but it is also the case in South Africa. So again, then depending on the shock, think of a bad luck, price of commodities goes down, we have less GDP. In this case, it might be better to have the foreigners bear this exchange rate risk. Of course, it will depend on general equilibrium if they're bearing that exchange rate risk, if at the end they're actually buying more or less debt. So it's a quantitative issue. But one might think that now that they have more options, it should be better. They can buy domestic currency, but they can still buy in foreign currency. They can buy plain vanilla bonds, or they can buy index. They can buy short-term debt, but now we can also extend the debt. They can buy issued in local courts or issued in New York, and there's also options for hedging. So again, we seem to now have more policy tools, and we're hoping these more policy tools do allow us to reduce these adverse shocks. So in general, this better debt management, choices over currency, maturity indexation, I do believe have allowed us to overcome a little bit the fear of floating. You do see countries allowing the exchange rate to float a little bit more. This is also related to countries are now using more interest rate policy the way they should, and you saw a lot of emerging markets lowering the interest rate. I actually do think inflation targeting has played a big role. There's a recent BIS paper that highlights some of the benefits of inflation targeting in some emerging markets, for example, Mexico. This has also allowed to deepen financial markets. There is some evidence of also corporate seeing redemption, especially in equity markets by Sergio Schmuckler and co-authors. But we have also seen growth of financial hedging. I have a paper that in particular has looked at the case of Chile. And again, Chile is a very interesting example because you do see the growth of hedging despite the exchange rate variations. And as was mentioned, the pension funds played a huge role behind this growth. There's also options to use macroprudential. Here, I am a little bit more cautious because we have seen a flow away from bank flows and tax havens. And again, it might be the search for yield, but it might also be some of these macroprudential. And I'm also a little bit more cautious in terms of capital controls in work that I have done with Andres Fernandez from the Banco in Chile. We don't see that controls are used as models. And there's also a survey in this BIS document that policymakers argue that they're not as effective as in models. Part of the issue is models take the development of financial markets as given, and capital controls may get in the way of developing the financial markets. But again, we have more options. General equilibrium matters. But what if the concern is willingness to pay and debt intolerance, as Carmen mentioned? And as we just saw, there is evidence of double whammy in some of these countries. So if the concern is willingness to pay, does it matter who bears the exchange rate risk? If you're going to be evil, probably it's still better to be evil in your own currency. So if you're going to sin in colones, in case you don't know, that's Costa Rica's currency. But again, the currency choice is not going to hedge institutional capacity broadly defined. And when you look at some of the effects of the crisis, and I do think countries should have used fiscal, I do worry that you start seeing countries getting closer to 60, 70, which have been usually complicated numbers in terms of debt intolerance. And I also worry when you see very high deficits that are not coming down in good times. I worry, and again, let me pick on my region, that now that we're seeing growth rates, I'm not seeing savings in good times. If you're a good Keynesian, you spend in bad times and you save in good times. And some of the political cycle is perhaps not created those incentives towards start behaving, if you want, different in good times. But as I'm from Costa Rica and we tend to be optimists by nature, let me just say that perhaps there is some new hope. There is some increase at the end of domestic currency bonds, and perhaps we have built some resilience in terms of policy tools. Thanks.
Thanks very much, Laura. I hope everyone can hear me now again. Shall we switch then to Prof. Senbet for his take?
Am I able to share my slides?
Yes, we will project your slides shortly, Prof.
Oh, you will? Okay. Yeah, thank you. Can you put that in slide mode? Next page. Next. Okay, greetings from Washington. It's a privilege for me to participate at the centennial anniversary of SARB. Thanks for the invitation. It's also a pleasure, by the way, to discuss the presentation by him. And as we know, this is anchored on original sin, the difficulty associated with borrowing in your own currency, especially for external borrowing. Even domestically, as Laura mentioned, you could have difficulty when you actually issue long-term maturity bond domestically. So This is actually, this discussion is um, grounded in the pandemic. And as noted, the fiscal policies have actually led in terms of responses, leading to budget deficits and debt. So now I'm going to focus on the debt part, because one of the things that I noticed is that the discussion, the presentation is mostly in the context of advanced and emerging markets. So I was just wondering, what the implications are for frontier markets. So I'm going to take Africa an example, since, as you know, Africa is home for South Africa. So I'll come back to that as well. So in the as you can see, there is now discussion about this many countries overcoming original sin. But I also see that increasingly these domestic denominated bonds are being held by domestic investors. There, I think we need to have a little bit more clarity. What does original sin mean in that context? And then, in fact, you see that there is shrinkage in the share of sovereign domestic currency bonds held by foreign investors, and that's actually kind of bad news. So in that case, what I want to see really is that this is a very good presentation, but it really comes in terms of refinements. I need to have a kind of more compelling notion of how this original sin is being overcome. And then, of course, yields have gone up, and there was a discussion of linking those with high perceived risk. What I would have liked to see is really kind of going into disaggregation of these forms of risk, the kinds of risk, and the extent to which exchange risk actually is important. So then Iran moves from what he calls original sin to original sin redux. I don't want to spend much time on this lingua, but I just looked at the anatomy of what's going on. This is the next slide, please. Next slide. Okay, so so in the next slide, really this issue of currency mismatch. And then the migration, this interest migration from borrowers to investors. Now, this is reflected in the higher duration multiplier. By the way, the duration multiplier is not a widely known concept in finance. So typically we think of bond duration as sensitivity of bond price changes to interest rate changes. Then the second derivative being convexity. But the duration here is measured by a fitted swap coefficient from the regression of the US dollar returns and local returns on a basket of emerging currencies. And as was shown, that multiplier actually has gone pretty substantially ahead of 1 for a number of emerging countries. Mexico, Brazil, Turkey, and even South Africa in this case. So again, what I was kind of missing, maybe it's in the original paper, there is a variation in these duration multipliers. And I wanted to see how that is actually explained. Because when you go to the recommendations, this is the next slide. You really point out this capital market development, which is very close to my heart, and that's probably where I intersect with you when it comes to Africa, right? So, so in this case, really, variation matters. Is that, for instance, is driven by the spread between U.S. Dollar returns and local currency returns. But I think really getting into the disaggregate variations would be very useful. When I also noticed, maybe it was not intended, I got the impression that the benefits of domestic bonds, domestically issued bonds, seem to be discounted. And then I was thinking of like Japan and Italy, which have been issuing large quantities of domestic, and it's been sustained. And I was just wondering what that implies for emerging markets. So from here, one of the things that I would have liked, maybe this is beyond the scope of this analysis, is what is the implication for low-income countries? So absent that, I thought I should give you some kind of linkage this with Africa, because African countries have been borrowing actually in foreign currencies. Could you go to the next slide, please? Next. Actually, previous slide, please. So as you know, in terms of COVID awakening, the economies got hit immediately, even before the virus showed up in their shores. Because of linkages, global linkages, EU, US, China, UAE, and then of course shrinkage of fiscal space. And now that builds up and distress. And what COVID-19 has awakened us is really the imperative of domestic resource mobilization and financial sector development, which is really where I'm kind of intersecting with here. And the next slide, please. Yeah. So Africans have been borrowing, and for the first time, they start accessing international credit markets at arm's length for two reasons. There was a pretty substantial growth renaissance that was witnessed in the region, and also low global interest environment. Now, it turns out that this is very good news. I mean, that's a bright. The dark side is that due to diversity and diffuse creditor base, we have no difficulty when it comes to restructuring the contracts. Now, what is the pandemic effect? So the debt levels actually rose substantially in sub-Saharan Africa in the onset of COVID-19. In particular, the SSA experienced an average increase of 4.5% relative to the projections that were actually made pre-pandemic. And this was much more acute for HIPC countries. These are the countries which actually graduated from the old HIPC days. For that, the increase was 8.5 relative to the projected. Now, then we're also witnessing that the HIPC countries are now getting rationed out. They're actually having access to international credit markets, although the non-HIPC guys actually continue to access. What is interesting, which is very similar to what Hein is saying in his presentation, is that the domestic bond market has actually played a more important role in private borrowing in these markets. And it turns out that simultaneously the Eurobond issuance, which was really prevalent, which was one of the components in this foreign borrowing, it has actually shrunk quite a bit. So, of course, associated with this good news, and then, of course, the bad news when you get into distress, and debt service costs have actually gone up, especially those inclusive of principal repayments interest that have also gone up. And so we are kind of a looming crisis. So failure to meet debt service obligation will have devastating impact, including downgrading of credit ratings, and then, of course, future higher costs, and then higher pressure on foreign exchange reserves, and then domestic currency depreciation, and then the real possibility that these countries could be rationed out of the credit markets. So next, please. Okay, this is just showing debt service costs. They have gone up. And then the next one. Yeah, and this is also shows this increased reliance on domestic debt. So where I'm going to converge with our presenter is in terms of mitigation. And really the imperative of financial sector development. Often people say about domestic resource mobilization, and there's those that do so saying, okay, we can actually enhance this by efficiency in tax collection and so on. And the whole idea of building resource mobilizations for financial market development, this book is often ignored. So what is interesting, next please. What is interesting is that in the presentation earlier, you know that one of the variations that you haven't looked at is really the extent to which the emerging markets themselves actually vary in terms of the level of development currently, right? And in Africa, you actually see that line that you see here is the benchmark financial development for low-income countries outside Africa. So we kind of projected that on Africa. You see that a lot of countries are actually beyond the line. There's a lot of variation. Now, the way that we are trying to bridge this gap is in a number of ways. And I'm going to end with one very positive development. A lot of these markets are very thin, low scale, and in the long run, they cannot survive without being consolidated. And the question is, how do you consolidate? How do you integrate this? And so one of the things that happened recently is the advent of a free trade agreement in terms of population, very large. And one of the features of that free trade agreement is actually integration in financial services. So I see the COVID-19 awakening not only speeding up the development of the financial sector, but also speeding up the implementation of they call AFCFTA. And so and finally, I think it would be very interesting, to do this the duration multiplier analysis on African economies. But you know that they will have a lot of difficulty. It's very difficult for them to actually issue that in their own currencies. And that, so the original scene phenomena and how these, the multipliers vary and how actually they show up in the low income countries would be one interesting extension that I would like to encourage the presenters, and I'm going to stop it.
Thank you. Thank you very much, Prof. Senbet. So we've heard the discussants. I think it will be quite a robust interaction that we're going to have. There have been a few questions posed in the chat, but just to cut the monotony so that you're not just hearing my voice and the panelists' voices, I would encourage that for those who are on the panel platform, please to utilize the raise hand function so we can hear more voices than just the four of us. Perhaps just to kickstart the conversation, I do want to ask whether the panelists think that the strength of the dollar is a bigger driver of the recovery in hard currency relative to domestic currency debt, and how much of a factor is this? And I think this is the direction that that Hyun would like us to take, that we can focus on how much of dollar-based indexation is a big driver of some of the dynamics that we're seeing. And while you're pondering on that, I think the chief economist of the South African Reserve Bank, Chris Lualt, has a question. Go ahead, Chris.
Thanks. Well, I put them in the chat, but I can repeat them. So I mean, I guess, you know, one obvious question is just how much of what we've seen in terms of non-resident holdings of emerging market debt is a function of just higher uncertainty. And as the pandemic kind of fades and the recovery continues, this will revert and non-residents will come back into emerging markets for the same kinds of reasons that they came in the first place, which is that often growth was higher and returns were better. So I mean that's the basic question. I suppose the second question is you know, have we turned the corner in a structural way, either with growth and or macroeconomic policy, which suggests that non-residents won't come back in very easily, and that there are things that emerging markets need to do differently to lure them back in. I mean, do we need to look again at the robustness of our macroeconomic frameworks? Yesterday, we heard a lot about fiscal policy being an issue, but perhaps there are some monetary policy directions that we could think about. You know, how and of course the pension system came up as a potential area of reform for deepening domestic markets. I mean, certainly in South Africa's case, I would also note that much of the local currency assets that were sold by non-residents in the crisis were picked up by resident holders of foreign assets. So they were South African residents were selling their holdings of dollars and euro and other assets overseas where the prices were high and the returns were low, and came back into the South African market. So this long period of reintegration with international financial markets that South Africa embarked on many years ago has proven to be very useful in the crisis, and we saw that also in the global financial crisis very strongly too. Thanks, panelists.
Thanks very much, Chris. Let's take the hand that's there at the moment, Rashad Kasim, and then we'll return to the next round of questions.
Yeah, thank you very much, Fundi. My question is to Yun. You know, when we look at the local currency bond curve, the yield curve in an emerging market, we kind of spend a lot of time, like everyone else, trying to work out how much of the yield curve reflects fundamentals, how much of it is technicals, how much of it is you know, foreign debt or public debt and so on. But when you think of the determinants of the yield curve issued in hard currency, is there difference explained purely by you know, by the foreign exchange risk, or is it that a hard currency yield curve also throws the fundamentals in a very different light? Its determinants have to be seen in a very different light. And I guess one way to extend it is, how do you compare the spread between, you know, what determines the spread between a hard currency you know, yield curve in an emerging market versus, say, you know, some of the smaller open economies like New Zealand, Australia, and so on? Thank you.
Okay, back to the panel. So there's one question that's directed at Hyun, and the rest of the questions can be divided up among the panelists. So back to you, Hyun.
Thank you, Fundi, and thank you for those questions, Chris and Rashad. If we look at the chat, I think Chris has laid out the questions very well. So, so one question is, how much of the shift in local currency holdings by non-residents is simply a function of the pandemic, and will it revert? I think it's important to think about the longer context here, Fundi. Before the GFC, most of the cross-border flows were intermediated by the banking sector. And the shift from the banking sector to the fixed income world, that is very much a post-crisis phenomenon. And I think for that, the few years following the GFC, especially when the dollar was quite weak, you know, even after the taper tantrum, there was a very big run-up in the integration of the bond markets across borders. It's really from that period in the middle of 2014, when the dollar began to strengthen, that we see these proportions of domestic currency bonds held by external investors, you know, that proportion languish, as it were. If you speak to investors, what they say is, of course, the higher nominal yields are a compensation, but they also give a sense of disappointment that exchange rates have really moved against them. When they're investing in dollar terms, and that this latest setback is really the latest of of a series. And I think that's worth thinking about, in that it's less the macro discipline, the monetary policy discipline, and the fiscal discipline before the pandemic that I think was at issue. There was to a large extent this sense that exchange rates have tended to undermine that kind of a higher dollar denominated return. And this is also reflected in some of the calculations that I've seen from the private sector, where they say, if our mandate were, let's say, 50% euros and 50% dollars, we could have, as it were, produced a less volatile and perhaps even on an average basis, a higher return. So I think, Chris's question is actually a very difficult one to answer. But I think whatever the situation was before the pandemic, it's become a little bit more challenging now because of the fiscal, because of the importance of fiscal space in the policy response, going forward. And as you saw in one of my charts, the yield spread on domestic currency bonds has actually stayed up, pretty high. And to address, Rashad's question, I think it's fair to say that it's much simpler to measure the spread and try and decompose that spread in terms of a pure, risk component versus an underlying credit risk component if you don't have the confounding effect of the exchange rate. You can do something almost as good by having a hedged basis comparison. So you imagine that a dollar-based investor swaps into the local currency, invests in the local currency bond on a hedged basis. And then what you can do is extract a measure of the spread with the currency risk hedged. But of course, that also incorporates some of the CIP deviations that are inherent in the swap market as well, and so it's not a perfect measure. But nevertheless, on that measure, we do see that the spreads on local currency bonds tend to be somewhat higher than you would expect, given the spreads on the dollar-based bonds.
Thanks very much, Yun. Laura, shall we turn to you on your take on some of these questions? Go ahead.
I think it's probably going to be a little bit repetitive, but I do think there was investments in better macro management, if you want, and I think we did see the payoff of that in terms of we could use fiscal policy, monetary policy, and so on. But we're now worse, even for countries that had low debt, and I'm thinking even Peru or Chile that had very low debts. If you start accumulating fiscal deficits of 10, very soon you start getting into complicated problems. Let's keep in mind also that many emerging markets, if you want, wasted that low interest rate decade, and we didn't do productivity investments, we didn't do infrastructure investments. So we have that history, and now a little bit worse macroeconomic situation. There's also something interesting about these very low interest rate periods, that they have come with very little monitoring. So there has been very little monitoring by the private sector and very little monitoring by the multilaterals. So not all countries have spent the money, if you want, the best way possible. And so that's the world we're now. I think it's very easy to just turn the foreigners into the villains, but I think they're right into having well, let me see now, what is it that you're going to do? And try to see how you're going to really get out of this mess. And behind that, they're going back to maybe dollars and requesting higher returns and so on and so forth. But as I said, there was some investment, and if we do behave well, and I do think they will come back.
Okay, thanks, Laura. Prof. Sendet, anything you'd like to add? before I move on to the next set of questions in the chat.
What I wanted to add was the borrowing and what it's being used for. And I think it was implied in Laura's response here. You know, in some countries, by the way, some of this indebtedness has been exacerbated by corruption. You know, this, so misallocation of resources. And then, of course, the pandemic crisis has actually exacerbated, especially in the African context. And things have actually gotten worse. And it's not very easy, really, to see how we're going to get out of this. Yeah, thank you.
Thank you, Prof. So just turning to the questions that I'm seeing in the chat, there's one question that is probably more relevant, Laura, given your previous incarnation, and you've started to touch on it, which asks how much of a factor of domestic policy settings, how much of a driver are domestic policy settings to the lower or slower recovery of local currency bond markets. And the question is more focused on the poorer growth dynamics and the size of the fiscal risks and the size of fiscal issuance, and whether this is not a bigger concern for investors at this point in time, and the fact that the slower growth and the fragile fiscal environment is likely to affect countries' ability to pay debt over the next few years. The second part of the question is whether we have crossed the debt to GDP thresholds, which investors regard as too big a risk. And whether when we look at fiscal matrices in countries, and I think this came up yesterday when Carmen reflected on this during her presentation, about the sensitivity of emerging market and developing countries to debt relative to their advanced economy peers. There is a question about whether the speed of normalization in advanced economy countries by advanced economy central banks matters to the multipliers, and that is to Yuan. If you can just provide a response to that question. There's also a question that asks, to what extent is the shift to local currency being driven by unconventional monetary policy? And what are the implications for financial stability thereof? So perhaps we can take those questions, and let me hear reflections starting with you, Laura, in terms of just the policy settings. You've highlighted some of the structural reforms. Maybe you want to expand on these as well. Thanks.
So again, depending on your country, and I represent a small open economy, so we will always be affected by external factors. There is no world in which Costa Rica can close and be fine. I guess I can live from bananas and coffee and be fine, but that's it. We won't develop, we won't grow. And I do think many countries are on that. They're the larger countries that perhaps can afford and can insulate a little bit more, but that is the reality of many emerging markets. We will depend on external situations. Having said that, there is many things we can do. And so there's always the discussion on the pull and the push, the external and the internal. I do think some of the gains we saw are not only because of low interest rates worldwide and the search for yield. I do think we put our house in order and we did better things. But we didn't improve everything. I was yesterday in a talk on productivity. The productivity problem is serious. It precedes this crisis. And so again, we need to get into it. Depending on your country, again, if you, so for example, Costa Rica is now a country that is out of the private market. The lending we got was from the IMF. So we're hitting 60%. And at that number, investors worry. And I actually do think they worry correctly. And so they wouldn't lend to us. We went to IMF. Brazil is higher than that. The investors still are in Brazil. And I think if Brazil does things well, they can continue to convince investors it's a good place to be. Again, it depends on the characteristics of the countries, but many of us are hitting the number that investors correctly start to worry.
Okay, thank you. Prof. Sandbert?
Yeah, I just wanted to say something a different angle. So one of the reasons that we're grappling with that issues is that we're dealing with completely plain vanilla straight debt. And I think that we need to make some more progress in terms of the design features of debt securities, which are actually incentive compatible. And that I think in that sphere we have actually failed. So when it comes to low-income countries, it's not just a low-interest environment. A lot of these countries actually have gone through all kinds of reforms, reforms of finance, economic reforms. So that coupled with low-interest environment has been a stimulus in terms of their access to credit markets. But then, as I mentioned here, it also depends how these things are actually utilized. And then we're also dealing with hidden lending, basically implicit lending that is actually usually carried by state-owned enterprises. Sometimes when we deal with that, we don't really count it properly. We're probably understating the problem. Okay. Thank you.
Okay, thank you. So Yuen, as I turn to you, I'm quite tempted to add this question that has also been asked in the chat for you to reflect on, whether the risk premium is calculated in the same way for both the domestic and hard currency bond yield curves, and whether investors are using the same matrices when they are considering whether they should be investing in the domestic currency denominated bonds or hard currency bonds. So over to you, Hyun.
Thank you, Fundi. That's a very important question because the domestic currency yield curve clearly is the benchmark that we are looking at for monetary policy purposes. That is the benchmark that transmits financial conditions throughout the economy. The whether the risk premium in that yield curve is justified or not, I think depends very much on the capacity to take risk on the part of the investors. And although I didn't have time to go through the precise mechanisms today, I think one thing that is emerging from the work that we're doing here at the BIS is that the apparent procyclicality of risk capacity, and in particular the role of the broad dollar index in being a barometer, if you like, for that risk capacity, is that the numeraire and the currency in which you evaluate your gains and losses provides a base from which you measure the whole range of financial assets. And to the extent that the numeraire itself is appreciating, everything else is depreciating, and that this injects, if you like, a squeeze in the economic capital of an investor. So if you have a value at risk model, which says that your value at risk has to be below a certain point, and your economic capital is shrinking, then of course you would tend to reduce your portfolio, more broadly. And this is what I would conjecture as being injecting this endogenous correlation between the exchange rate itself and the underlying financial conditions. So to that extent, if the two sources of risk are being, if you like, compounded, you would expect the risk premium to be that much higher. And indeed, this is what this is what I was referring to earlier when you calculate these hedged spreads, where the dollar-based investor enters the market on a hedge basis. If you calculate the return from that kind of strategy, it does seem that the domestic currency risk premium does seem to be larger. Now, one thing which is much more much more promising and much more, I think, hopeful is the experience last year when, in the height of the crisis, we did see very rapid depreciation of emerging market currencies, very sharp capital outflows, portfolio outflows in particular. And yet emerging market central banks were able to cushion financial conditions by actually intervening directly in the market. So there were these asset purchase programs that were brought in. It's really a strategy that's much more common in the advanced economies, but emerging markets were able to deploy these tools. And the fact that they were able to deploy these tools, I think, is a sign of growing maturity, of these markets. Of course, it was helped by the fact that global liquidity conditions were very ample following the monetary policy actions in the advanced economies. But nevertheless, I think it was quite a remarkable turnaround in that emerging markets, developing country central banks were able to deploy these asset purchase programs. Of course, for financial stability reasons and market functioning reasons, rather than QE in the traditional sense for monetary policy purposes. So I think there are signs of hope. There are signs of maturity. And to the extent that we can identify and more surgically target those sources of vulnerabilities, and to the extent that we can mitigate some of them, actually take steps to do so, I think the future is not as bleak as we may fear. And yesterday's discussion was I think a great discussion. I left the session though a little bit with a sense of, well, perhaps this is the picture is perhaps a little bit too dark compared to, I think, where we could be. And so I'd like to just maybe underline this aspect that yes, there are great challenges, but there are ways that we can mitigate those, and I think we can certainly do a lot more to cushion, these sources of procyclicality, both domestically and on the part of the investors as well. And here the multilaterals, of course, and the BIS have a really important role to play. So I would just end with with a more hopeful note that things are not as bleak as we may think in our more darker moments.
Thank you very much, Huynh. And Huynh, you've just helped us to manage time very well. Perhaps Laura and Prof. Sendit, if I could just turn back to both of you to assist us in wrapping up with your final thoughts in 2 minutes each on what is it that you see as being important from a financial stability purview now for central banks or market participants to take into account in the period going forward. Let's start with you, Prof. Sendit. Prof. Sendit, you are muted. Please unmute your microphone.
So I want to come back to low-income countries. I know that that's not the main subject of your story. And Hein actually have really painted a very, very positive outlook, well, let's say positive outlook really for the remaining segment of the world economies. And I was just wondering what is that you can actually do to actually be in the same spot for the low-income countries. And so that's why I was really emphasizing, especially in the context of Africa, to be self-reliant in accelerating financial sector development. And there are many ways to do that. I gave you one example. It was based on regional integration. And that is also important in terms of dealing with this shrinkage in the fiscal space. And it's not being, that gap is not being filled by traditional means. We need to be more innovative and tap into emerging markets. Thank you.
Thank you very much, Prof. Sandberg. Prof. O'Farah, over to you to help us close up.
I just want to go back again to this more hopeful ending. I do think we have gained a lot of policy space, and that has allowed us to do a little bit better. I think it's time. The emerging markets have taken the lead in increasing interest rates because inflation is a real threat. And I think it's time for the rich countries also to normalize monetary policy and to limit spillovers.
Okay, thank you very much to our esteemed panel. This is a subject that I think we could spend a bit more time on. And Mr. Shin introduced this idea of new ideas that we could be thinking about in terms of just thinking about the currencies that we utilize for indices. I'm really looking forward to finding space in the future for us to explore this hopeful future that they've introduced and to look at instruments for consideration by central banks. In 45 minutes, we have another session, which is going to be quite a robust panel that we're going to have starting at about 5 p.m. South African time. So please do log on, and I'm certain you would have received information on that. We'll be joined by the General Manager of the Bank for International Settlements. We will also be joined by the Governor of the South African Reserve Bank. We'd also be joined by the Fed Chair for the session as well. So looking forward to that session. For those of you unable to join directly, it should be aired live on Bloomberg as well. Thank you very much.
Thanks.
Thanks, everyone.
Thank you.
Thanks all.